everyone. Tonight, CPA Tom Hill is back to talk to you about tax time and the things you need to know about your filing your taxes this year. Tom has been a CPA for over 35 years in the area in Troy and has come to speak to our library for many years. But this year is the first year that we'll be virtual on Zoom. How we're going to run the program tonight is Tom has a presentation up on the screen, and every so often he's going to pause for questions. So down at the bottom of your screen, if you want to have a question, put it down in the Q&A, and each time he pauses, I will state those questions to Tom, and he can answer them for you. We want to thank the Friends of the Library for supporting programs like this tonight, and without them, we couldn't have great programs like this. So with that, Tom, I'm going to have you take over the screen, and I'll be in the background, and we'll be answering questions as we go on. Thank you, Tom.
Okay, thank you, Maggie. Well, as Maggie said, I'm a CPA. I've had my own tax return business for well over 30 years now. Longtime Troy resident. I work out of my home in Troy, and worked for several years for GM in accounting and finance, and always had this tax return business on the side. And now I'm doing it pretty much full time during tax season. I'm basically retired. I come out of retirement this time of year for a couple of months, and go back to retirement in my golf game in mid-April after tax season. So the first thing I want to show you is my contact information. I've done this presentation many times, and I found that a lot of people would like a copy of my slides. So as Maggie mentioned, we're going to record this entire program, and you'll be able to view it with the slides and the audio through the library website. But if you just like a copy of the slides themselves, my email address is up on the screen, and you can email me and I'll reply back and send you a PDF copy of the slides. I've also got my cell phone number there. Like I say, I work out of my home in Troy if anyone is interested in tax preparation services. We're going to talk about a little bit about what you need to know for this filing season that really just started. Just last Friday, the IRS began accepting and processing 2020 returns. So up until this point, they would not accept or process an electronic file of your returns or a paper file, but they are now. And I really do highly recommend that you do electronic filing. The IRS, they were shut down for COVID for, 2 or 3 months, and they're extremely behind. I read that when they came back, they had over 12.5 million pieces of mail to process. And I know several people that mailed in their return on paper in 2019, their 19 return, and they still haven't received their refund. So where if you do electronic filing and if you do direct deposit, then you can get that refund right in your bank account within 3 weeks of when you file. So electronic filing is definitely the way to go. Last year, they extended the filing deadline because of the COVID to July 15th. What they said at this point is that that's highly unlikely this year. So we're stuck as of now with the April 15th deadline to get your 2020 return in. But you can file an extension. The extension does give you 6 more months to get that return in, but not 6 more months to pay if you owe. So what you have to do if you're going to file the extension is you have to estimate what you think you might owe, take your best guess, estimate on the high side, and you have to make that payment with your extension request. And then you'll reconcile when you do your actual return. But it does give you at least 6 more months to do the return itself until mid-October. And if you're sure you're getting a refund, there is no need for an extension. The IRS will keep your money as long as you let them. So if you're very comfortable, you're getting a refund, don't worry about April 15th, just get it in when you can. As I mentioned about Efile, almost 90% now of all returns are electronically filed. So if you're still the type that likes to get the paper and fill it out by hand and mail it in, you can still do that, but you're in the definite minority. And as I said, if you e-file and go the direct deposit route, you will have that money in your bank account within 3 weeks, assuming the IRS accepts your return. And you'll get the software will tell you that you used whether or not the IRS approved and accepted your return. Efile is also very good because it catches common mistakes that people make on their return. When they used to do it by paper, it'll tell you if you made a math error or you're missing Social Security information, and it'll do a review of your return too, and remind you and catch certain errors. There is free e-file software available through the IRS. If your income is $72,000 or less, you can e-file for free through that website I have there, irs.gov/freefile. And they'll link you to programs like TurboTax or others where you can actually electronically file for free. Use that software and file for free. If you have to buy the software, TurboTax is the most popular. That runs, I think, anywhere from $50 to $100, depending on how complicated your return is. The more complicated, the higher version of the software you have to buy, and it gets a little bit more expensive. As you probably know, we have one of the most complicated tax codes, tax systems in the world. Our tax code right now is 4 million words long. That's the equivalent of 11,000 single-spaced type pages. And not only is it long, but it's constantly changing. So since 2001, there's been over 4,500 changes to the tax code. And this year was no exception. I've got here listed all of the laws that were passed just since last tax filing season that will impact your 2020 return. All of these contain changes that you'll have to be aware of in your return. And I'm going to go through and talk about some of the major changes in this presentation that impact the most number of folks. So the one that we're probably all aware of is the COVID stimulus payments. They call them economic impact payments that were sent to eligible taxpayers. So in the spring, about April or May, you should have received a payment for $1,200 if you file single, or $2,400 if you file jointly. And also on top of that, another $500 for each dependent under age 17. And they would have been looking at your 2019 tax return to determine this, because of course they didn't have your 2020 return yet at that time. And then in just last month, there was round 2 of the stimulus payments. And that was $600 if single, $1,200 if married filing jointly, and $600 this time for each dependent under 17. So you should have received that about a month ago, first part of January. Now there were some income limits on that. It does phase out. So, and again, when they did the spring 2020 payment, they would have been looking at your 2019 return. So if your gross income there is between 150 and 198, it would have phased out. You would have received a reduced amount, basically 5% of the amount that you exceeded the 150. And if you were 198 or higher, you weren't eligible for any payment at all. You can see the numbers there for head of household, if that's how you filed, or if you filed single or married filing separately, those are the limits there, or the eligibility and the phase out. These payments are not taxable income. You do not have to claim them as income when you do your 2020 tax return. And if you were eligible to be claimed on another person's return as a dependent, for example, your college age kids, for instance, if they're still your dependents, they are not eligible to receive the payment. Only if you can't be claimed as a dependent on someone else's return and receive the payment. There are some special rules for deceased taxpayers. So basically the rule is that if you were still alive when that first payment came out, you can keep it. So if you died after the first payment came out, again, the IRS didn't know that you passed away in 2020. They were looking at 2019. So if you did receive a payment for someone that passed away after they received the payment or before they received the payment, I'm sorry, if they passed away before they received the payment, you can keep it. If they passed away after you received the payment, it has to be returned. That's for the first payment. For the second payment, as long as the deceased taxpayer was alive on January 1st of 2020, you're eligible to keep that payment. Now, you may be eligible for additional payments because, again, they used your 2018 in some cases or your 2019 return when they determine your eligibility, you know, those income limits I talked about and your filing status and so forth. But what if your situation changed in 2020? Maybe you never received the payments at all because your income was too high. Well, what if your income went down? Or what if you had a child that was born in 2020 or you added another dependent? Then you are eligible to claim that payment that you were shorted on this 2020 tax return. So when you do your 2020 return, it's going to ask you, did you receive a payment? And if so, how much for both the first and the second payment? You put that information in, and then it'll tell you if you're eligible to receive more. Because again, the final calculation of what you're due is based on your 2020 tax return. They used 2018 or 19 just because they wanted to get the payments out quickly. The actual eligibility and calculation is based on 2020. So you will be able to claim that additional. And if you have a case where you receive too much, you do not have to return that excess. So if maybe you had a child who was 16 in 2019 and then turned 17 in 2020, well, technically then you're not eligible for the payment for him because he's now 17, but you can keep that. You don't have to return excess payments. The only time you have to return an excess payment is, like I say, if you received a payment for someone who passed away before the payment was actually received. At this point, I'm going to pause for questions. I know I've got a lot of questions from my clients about these stimulus payments. So Maggie, do we have any questions in chat?
Not yet. If anyone has a question, go ahead and put it in the Q&A at the bottom and I'll state those to Tom. If anyone has a question, go ahead and type it in.
Okay, I'll move on and then we'll pause again a little bit later for questions. Some of the other big changes in the new tax laws that affect your 2020 returns relate to required minimum distributions. So now it used to be that once you turned 70 and a half, you had to start taking annual withdrawals from your IRAs. They were required. And that rule now changed to 72, but it's only for anybody that turned 72 after January 1st of 2020. So if you were already 70 and a half at January 1st, the old rules still apply to you. You do have to take those RMDs. But if you turn 72 after January 1st of 2020, you don't have to begin those required minimum distributions from your IRA account until the year you turn age 72. Another change is that it used to be that once you turned 70 and a half, you couldn't put any new money in an IRA. You could only pull it out. You couldn't put any new money in, even if you continued to work and if you had earned income. Now that's changed. So you can continue to put in money into an IRA for your entire lifetime, but you do have to have earned income, meaning, wages, W-2 income, or self-employment income. Another big rule change that got a lot of press is there's no more what they call stretch IRAs. So it used to be that if you inherited an IRA, you had to take annual withdrawals from that IRA, that inherited IRA, right away, even though you weren't 72 yet. Inherited IRAs, you had to take them right away. But you were able, when you calculated those annual amounts you had to take out, it was calculated based on your remaining life expectancy. The IRS had tables on that. So if you inherited an IRA at 35 years old, the IRS would say, well, you're expected to live till 80 or whatever the number was. And you would only have to take out a small fraction every year. What would that be? 1/35th or so, 1/40th of it every year over your remaining life expectancy. Now, the rule is that when you inherit an IRA, and again, begins for any IRAs inherited in 2020 or after, you have to totally clear out and withdraw that IRA within 10 years of when you inherited it. So, you can wait until the 10th year and take it all out at once, but you'd have a big tax hit, of course, that year. You did that. As long as it's cleaned out by the end of the 10th year, you're good. So you can't stretch it out over your lifetime anymore. There are a couple of exceptions to that rule. If your spouse inherits your IRA, they can still stretch it out over their remaining lifetime. And if your beneficiary is no more than 10 years younger than you were when you passed away, in other words, they have to be pretty close in age to you, they can stretch that out, continue to stretch that out over their remaining lifetime. So a couple of exceptions. Also, a minor child. If you leave money to a minor child in your IRA, they can stretch it out, but once they reach age 18, they have to follow the 10-year rule and get it all withdrawn, say by age 28, within the 10 years. Also, another change is, it used to be that when you took money out of an IRA before you hit age 59 and a half, you would pay a penalty, 10% penalty in addition to the income taxes. That is still free, or that is still true, I should say. But they loosen that a little bit. And now they say, well, if you take up to $5,000 out related to the birth of a child or the adoption of a child, we'll waive the penalty, even though you're not 59 and a half. We'll waive that 10% penalty. You still have to pay the tax on it, but no penalty for birth or adoption of a child.
Tom, I did have some questions. I've got 3 questions about the stimulus earlier. And
Sure.
the first one is, if alive at the time of the first stimulus payment in 2020, but passed away later than that year, must you return the stimulus payment?
Okay, if you were alive when the stimulus payment was received and then passed away afterwards,
Yes.
you can keep it. You can keep that payment, or obviously your heir can keep it.
Okay.
That's the rule on the first stimulus payment.
Okay.
On the second stimulus payment that was just made a month ago, if you were alive on January 1st of 2020, you can keep it. So you only have to return that one if you died in 19 or earlier.
Okay, so this other question is, if alive on January 1st, 2020 and died later in 2020, the second stimulus payment was not paid to the deceased taxpayer, is the deceased taxpayer eligible for the second stimulus payment?
Yes, that taxpayer died in 2020 in that example. You will have to file a final tax return for that taxpayer. And on that return, you can claim that $600 stimulus payment. Because for the second payment, as long as they were alive on January 1st, they are eligible for it. So yes, absolutely, but you do have to file a return, their final return, to receive that payment.
All right, and the last question in this set is there a special form to claim the EIP if you have not received your payment?
You would claim it, if you haven't received your payment, you would claim it when you do your 2020 tax return. There's a line on the 1040, I think it's on the second page, and it's called Recovery Rebate Credit. I don't know why they changed the terminology. Earlier they called them economic impact payments. Now they call them recovery rebates. But absolutely, if you did not receive it at all, or like in those examples I provided earlier, if you received a lower amount than what you should have, then you can claim it when you actually do your 2020 return. And there is a line item for that, and there's a worksheet to calculate that.
Okay, Tom, thank you. That was the 3 that was from earlier.
Okay. Okay, there are special COVID-related rules for people that took money out of retirement plans in 2020. So if you are a qualified individual, and we'll talk about that in a minute, who's a qualified individual, you had a virus-related distribution in 2020. So let's say, in order to get by, you had to pull money out of an IRA or a 401k. Even though you're not 59 and a half, there would typically be a penalty on that of 10%, like I said earlier. That penalty is waived for qualified individuals that had a virus-related distribution. And the other thing you can do, it doesn't waive the tax on that distribution. What you can do on the tax is, rather than claim all that income in 2020 when you took the money out, you can spread it over 3 years, 2020 through 2022. And that way not have to pay as much tax in 1 year. You can spread the hit over 3 years. Also, what you can do is, if you took the money out, but find a way within the next 3 years where you can put it back into your IRA, you can do that. And if you've already paid tax on it, you can get the money back that you paid. You'll have to file an amended return, but you can repay the money back into your IRA anytime within 3 years and get any tax back that you paid on it. And this is true for any distributions up to $100,000. Also, as I'm sure a lot of my over 70 and a half folks know, in 2020, you weren't required to take your required minimum distribution. So they waived that requirement in 2020 only. It was also waived for those who have inherited IRAs. No RMDs in 2020, but it's back on in 2021. I have heard no talk about waiving the RMD requirement in 2021. So who is a qualified individual for that previous slide I just talked about on the virus-related distributions? You're your spouse or your dependent, of course, if you're diagnosed with the virus, or if you any of the above experience adverse financial consequences as it related to the virus. And they're pretty liberal on this. If you were laid off, if you had to quarantine, if your hours were reduced, if you had to stay home and take care of kids and couldn't work, if you were self-employed and had a loss of income because of the virus, all of those make you a qualified individual, able to avoid the penalty and do the other things I talked about on that last slide. Spread the income over 3 years, repay the money within 3 years, and so forth. Some other big changes that affect 2020. Typically, most people don't itemize deductions anymore. I'm going to talk about that in just a little bit. But even if you do not itemize deductions, even if you take the standard deduction, you can deduct up to $300 per tax return for charitable contributions that you made. Basically, they passed this law to encourage folks to contribute to charities during COVID. So it can't be goods like, clothes to Salvation Army or that kind of thing. It has to be actual, cash, check, or so forth. And the deduction is limited to the first $300. But you can deduct up to that amount, even if you take the standard deduction. It has to be a recognized charity. Churches count. No GoFundMe's or no individuals, that kind of thing. Also, there is a credit available. It's called the Sick and Family Leave Credit. So if you're self-employed and you could not work because of COVID, again, if you had the virus itself, you had to quarantine, you had, even if you had symptoms and you sought a diagnosis, a test, you are eligible for this credit. And this credit reduces your tax dollar for dollar. And it's based on what your self-employment income is, what your net profit is from self-employment. The maximum credit is about $5,100 for up to 10 days of lost income. So that's a big benefit for self-employed folks that were affected by COVID. Also, for those that have college 529 accounts for their kids or grandkids or whatever, they expanded the reasons where you can take money out of those plans. So in the past, you couldn't take money out of the plan to make student loan payments. Well, you can do that now. And also, if you're in an apprentice program, you don't have to actually go to college. If you're in an apprentice program, for be it electrician or whatever, you can withdraw money from your 529 up to $10,000. And finally, if you go to a private school, elementary school, grade school, or high school, whatever, you could withdraw money from the 529 to pay for those expenses. So basically expanded eligibility for withdrawals on 529s. Also, if you're self-employed, I'm sure many of you know if you're self-employed that you have to pay payroll taxes, which is about 15% of your net profit of your self-employed business. The COVID law lets you defer a portion, basically half of those payroll taxes to 2021, if you'd like, rather than pay those in 2020. Some other changes that were made is in the past, they kind of fooled around with this limit on medical deductions. So your medical deduction, if you itemize deductions, in the past, your medical expenses had to be more than 10% of your income. And you could only deduct the medical expenses that were greater than 10% of your income. Well, they lowered that now and they made it permanent. So it's now 7.5% of your income. So any medical expenses are deductible that exceed the portion that exceed 7.5% of your income. There's also an energy credit available that was extended right now through 2022. So if you do energy related improvements to your home, new furnace, new central air, exterior doors, windows, insulation, there is a credit up to $500, but that's a lifetime credit going back to 2006. So you'd have to look at if you've ever claimed this in the past. The maximum you can claim, from 2006 forward is $500. Business meals now for self-employed again are now 100% deductible through 2022. They were only 50% deductible. Now, if you take someone out for a business meal, as long as you discuss business, 100% deductible. And for those of us that have mortgages, some folks have to pay for mortgage insurance. They call it PMI. They've kind of fooled around with this, made it not deductible. Sometimes it is, sometimes it isn't. Well, now it is a deductible expense through 2021 at this point. Could be extended again, but for now it's through 2021. So we talked about itemizing deductions. Is it worthwhile or should I itemize deductions? This is often the most tedious part of doing a tax return. It's coming up with all your deductions, going through your checkbook and figuring out all your medical expenses and all your charitable deductions and looking up your property taxes and so forth, getting your mortgage interest statements. Well, now, you only have to itemize your deductions if they're going to add up to more than your standard deduction. So, and I'm going to show you the standard deductions on the next page here. So they really increase the standard deductions, the amount they give you automatically. So there's no need to itemize if your deductions, your itemized deductions, are less than the standard deduction. Right now, only less than 10% of taxpayers will itemize deductions. The vast majority will take the standard deduction. So those standard deductions are, I've got them right there on the screen, for single, married, filing jointly, head of household, which is a single parent. And if you're 65 or over, you get an additional amount. So if you're married filing jointly and you're 65 and over, you get an extra $1,300 each if you're both over 65 on top of that $24,008. And if you're single or head of household and 65 or over, you get an extra $1,650. So you can see those standard deduction amounts are very high. Typically people don't have enough deductions to itemize unless they're very philanthropic. They have a lot of charity. If they have an awful lot of medical expenses, if they've got a huge mortgage interest. Otherwise, most folks now, like I say, over 90%, will take the standard deduction. Makes it much easier. I'm going to pause again right there. Maggie, do we have any questions?
Yes, we have two. The first one is, I think it is, person asks, how do you calculate to verify whether you received correct amount of stimulus payment for filing married jointly? So I guess
Okay.
they have a joint
Okay.
married jointly, and they want to know, how do they know if they've got the right amount of stimulus payment?
Okay. Well, the first thing you're going to need to know or look up is how much did you receive, if anything? So, if the IRS had your bank information, it would have been direct deposited. And in order to calculate if you're due any additional, you have to know what you did receive to begin with. And let me go back to that slide. So, okay, if you're married filing jointly, and if your income is 150 or below, you would have been entitled to the entire payment. And that payment was $2,400 for the first stimulus payment back last spring, and $1,200 for the one we just received about a month ago. That's for a married filing joint taxpayer. If your income was between 150 and 198, those payment amounts I just gave you are going to be reduced by 5% of that excess. So for instance, if your income was 175, you went $25,000 over the lower limit, your payment that you're entitled to is reduced by 5% of $25,000. If your income is as high as 198 or above, you're entitled to no payment. So did that answer the question, Meg? I think it did.
I think it did. Another question was about the energy credit. If let's say you did take that energy credit for windows in 2007 at one house, but you moved to a new house, can you do another credit, or you don't get any more for, a different property?
No, it's a $500 lifetime credit, no matter which house you lived in.
Okay.
So if you've already claimed $500 at some point between 2006 and now, regardless of where you lived during those years, then that's the max you can claim.
Okay. I have another question about Medicare. If you're on Medicare, can you deduct your Medicare Part B payments, also dental and eye care payment? Can you have a health savings account tax-free? That's what someone asked.
Okay, the first part of that question, yes, medical insurance premiums are deductible. So including Medicare premiums that typically are deducted right from your Social Security, those are considered medical expenses. So your Medicare and any supplemental policies you have, health insurance policies, as well as long-term care insurance policies, are all deductible as medical expenses. But remember, your medical expenses have to be more than 7.5% of your income to be deductible, and then only that part that exceeds 7.5% is deductible. Talk about health savings accounts. First of all, if you are already on Medicare, 65 or over, you cannot have a health savings account. If you are under 65, you can have a health savings account, but you have to have what's called a high deductible health insurance policy. And they define high deductible. I believe the limits are like at least is it $1,500 deductible for single and $2,800 deductible for married or family coverage. So you have to have that high deductible plan. If you do, then you can put money in a health savings account. And if you put after-tax money in a health savings account, you can deduct it up to a certain total. That total I don't remember right offhand right now. But you can put money in an HSA and deduct it on your return. Quite often, employers, your employer coverage is a high deductible plan, and your employer is putting money in your plan for you through payroll deduction. And but if you want to supplement that and add after-tax money into that HSA, like I say, subject to those limits, then you can do that and deduct it. If you already have an HSA, let's say you're over 65, retired, you had an HSA from the past, maybe when you were working, you can't add any new money to it, but you can continue to withdraw from it for medical related expenses you have throughout your life. I think that answers that one.
So Tom, you said that on Medicare, you can't have one of those savings plans. What if you have you're semi-retired and you have a part-time job?
Yeah, once you're on Medicare, it doesn't matter. You can no longer have a health savings account, because when you're on Medicare, you no longer are considered to have a high deductible health insurance plan. That has to be a private plan. So Medicare, once you're on Medicare, even if you're working, you cannot put money into a health savings account.
Okay. I have another question. Is a canceled check acceptable for a $300 charitable deduction?
Yes, it is, or a credit card bill, unless you're deducting a contribution that was over $250, a one-time contribution over $250, and then you have to have an acknowledgement from the charity, which typically they'll send you. Even for the smaller contributions, they'll send you a thank you letter. Thank you for your contribution of X dollars. It's a good idea to keep those. They're not required for the lower contributions. They are required if you were audited and they've challenged a contribution that you claim that was over $250.
And what calendar year is the EIP based on? Can you use your lowest year?
Yeah, that was very confusing. What happened is when they made that first EIP payment back in like March, April, they didn't have everyone's 2020 tax return yet. So they based it on the most recent return they had. I'm sorry, they didn't have their 2019 return yet. This was like March of 20. So when they calculated it and paid it, they looked at your income and your return from 2019. But really, the payment is calculated based on your 2020 tax situation. So that's why I said earlier, depending on what happened between 2019 and 2020, you may be entitled to more than you actually received. Or if you may have received too much. Let's say your income went way up in 2020 and you were over the limit. You may have received too much. You don't have to return any excess back at all. You can keep it, but you may be entitled to additional money. So I guess to answer the question, the final calculation of what you're due is based on your 2020 tax information.
Okay, I think that's it for now. Go ahead and go on with the
Okay.
slides.
Okay. One thing you can do, we talked about those high standard deductions right there, and how it's difficult to hit that limit. What a lot of people try to do is they try to bunch their deductions into the 1 year. So maybe you can't itemize every year, but maybe you can itemize in a particular year by bunching deductions. So some strategies to do that is, we all got our winter tax bill like in December. It wasn't due until February, but you could have paid that in 2020, and then you could have gotten that deduction in that year. Again, a strategy to bunch and try to get as many deductions in 1 year as you can. You could also make your January mortgage payment in December, and then you're getting 13 months worth of interest deduction. Now you only get 11 months the following year, but again, what you're trying to do is just go over that limit in this one particular year. Try to time medical expenses if you can. If you're going to have an expensive knee replacement, and try to put it off to a year where you think you might be able to itemize. Another big strategy that not a lot of people are aware of is that you can set up what's called a donor advised fund. And what that is that you put money in that you're giving to charity, but you put it all in 1 year into this donor advised fund. And then you distribute it to the charities when you choose over the next several years. So you can set up these donor advised funds through places like Fidelity or Vanguard or Schwab, and you put the money in there. So let's say you typically contribute, I don't know, $3,000 a year. You could put $10,000 in there in 1 year and dole it out over the next 3 years to your charities, but you get the entire upfront $10,000 deduction the year that you funded the donor advised fund. Once the money is in the donor advised fund, though, you can't take it back. It has to be distributed to a charity. those are some ways, like I say, to try to get over that standard deduction, at least for 1 year, and actually itemize deductions. Another strategy that's very valuable is you consider donating appreciated securities. So if you are able to itemize, if you have an investment that's gone up in value, a stock or a mutual fund, rather than selling that stock or mutual fund and donating the cash, it would be to your benefit to donate the security itself. And almost all charities, I'm sure, are set up to accept securities. And the advantage of that is that you get a double tax benefit. So you're going to get a charitable deduction for the entire market value, whatever that security was worth the day you donated it. And you will avoid paying any tax on the gain. So let's say you have a stock, that you bought for $1,000. It's now gone up to $5,000. If you sold that stock for $5,000 and gave the $5,000 cash to the charity, you have to pay tax on that $4,000 gain that you had on that stock. But if you donate the stock itself, you get a $5,000 deduction for what it was worth, and you avoid any tax on that gain that you had while you held the stock. You can also do this with donor advised funds that I just talked about. You can donate the stock right into the donor advised fund, and again, get a full deduction for the value of the stock at that time. I want to talk a little bit about the income tax rates. These are all, I say they expire at the end of 2025. There was a tax cut passed in 2018, and it lowered the tax rates, but they are scheduled to go back up again in the beginning of 2026. So I show here what the current tax rates are, but I have in parentheses there what they are scheduled to increase to in 2026. So these rates are based on your taxable income, not your gross income. So remember, you take your gross income minus your deductions, minus those standard deductions we talked about. And there are some other adjustments to income that are available to arrive at taxable income. And then you're going to pay tax on that number. I'm going to go through an example here in just a minute. And what a lot of people don't understand is they say, okay, I'm single, and my taxable income last year was $50,000. So I'm going to pay 22% of $50,000. I'm in that bracket. That's not true. What you do in that case, we have a kind of a mixed bracket or calculation. You pay only 10% on the first $9,875 of that $50,000 in income. Then for the next piece of income up to $40,125, you pay 12%. And then you're only going to pay the 22% for the part of your income that is over $40,126. So again, I'm going to show you an example on this, but you don't just pay the one rate. We have a blended rate where part of your income is taxed at each of these various rates. These are the rates when for single taxpayers. Married taxpayers are basically double. So taxable income, again, up to almost $20,000 is 10%, and then so on. Notice the big jump, between 12 and 22% there, almost a double jump there in the next bracket. So what I try to do with a lot of my taxpayers, especially those that are retired, where their income is more flexible and where they pull their income is more flexible, I try to keep them in that 12% bracket. The top of that bracket is a little over 80,000 taxable income. Their standard deduction, quite often they're 65 or over. So their standard deduction is, almost $27,000 or more. So that really means that they could have gross income of about $100,000 or more and still stay in that 12% bracket, without going into the 22% bracket. If you're still working, obviously that's harder to do. Your income is pretty fixed. Your W-2 is what it is. You can't change it. You can certainly try to put more money in a 401k to lower it, but this strategy works better really for retired folks that have different sources of income and more flexibility in where they get that income from. Okay, before I go into this example, any questions out there, Maggie?
No, not right now. Anyone have a question? Please type it in the Q&A. Thank you.
Okay. So let's look at this example. We've got a retired guy, 70 years old and single. He basically, his income is Social Security, and then he takes money out of his IRA to live on another $40,000. And he added up his itemized deductions, and they totaled $10,000 for the year. So his gross income is the 65,000, the 25,000 in Social Security and 40,000 from the IRA. Part of his Social Security is not taxable. Not all of that is taxable. The amount that's taxable depends on your income from other sources other than Social Security. It's a little bit of a tricky calculation. Your tax software will do it for you if you use software. But in this case, of that 25,000 he had in Social Security, half of it is not taxable. So he gets to subtract that out. And then he takes his standard deduction. Because he's over 65, he gets a little over 14,000 in standard deduction. So I set up above his itemized deductions, added up to 10,000. Obviously, he's not going to itemize because his standard deduction is higher. So he's going to take the standard. So you subtract out the standard deduction to arrive at taxable income. And his final taxes due on that, a little over $4,400. So it's only about 7% of that 65,000 in gross income. So remember, taxable income of a little over 38,000. He was single. So going back to this slide, he's in that 12% bracket, with taxable income of 38,000. But not all of that got taxed at 12. Remember, the first almost 10,000 got taxed at 10%, and then only the difference got taxed at 12%. So by the time you subtract out, in this case, his standard deduction and the part of his Social Security that's not taxable, he's really, paying a pretty small percent of his income, only about 7% in federal taxes. As I mentioned earlier, obviously you want to try to stay in that 12% bracket if you can before it jumps up to the next bracket of 22%. And the way you can do that, especially for retired folks, is you know how much you're going to need to live on. Try to plan where you're going to pull that money from. So oftentimes Social Security and pensions, they're not flexible. They are what they are. But if you have to pull any other money out beyond that, you might consider pulling it like from a savings account, because that would not be taxable. You've already pulled tax, or you've already paid tax on that. Or you might pull it out from a Roth IRA, which would not be taxable. And that could keep you back in that 12% bracket, rather than pulling it out from a 401k or a regular IRA, traditional, that would be taxable. You might also consider selling some investments, because you would they only add to your taxable income if you've had a gain, and only for the gain amount, not the entire sale. So there's really strategies that can be used to try to stay in as low a bracket as possible and decide, okay, I know how much I need to live on. Where am I going to get that money from in order to maximize my tax advantage? Some interesting facts about taxes. Right now, 60% of returns are done by pay preparers like myself. Another 35% use software like TurboTax. So, if you're the paper and pencil guy and the hand forms, that's only 5% of taxpayers right now. The average tax refund is about $3,000. And we have a very graduated income tax system where, the top earners pay the majority of the income taxes. So the top 10% of high income taxpayers that they define as 145 and up, they pay 70% of all the income taxes that are paid. The top 10% of income taxpayers pay 70% of all the taxes. And conversely, the bottom 50% on the income scale pay only about 3% of all the taxes that are collected. And almost half of Americans pay at no income taxes at all. So what forms am I going to need? You're probably getting all these forms in the mail now, right? They all start coming around the end of January or so. Obviously, if you're working, you're going to need your W-2. If you had interest income from a bank or a savings account, they send you a 1099 INT form. I think they're only required to send those if the interest is like over, is it 25 bucks or so? So, if you had interest less than that, you are still supposed to claim it, but you won't get a tax form on it. If you had dividend income, you're going to get what they call a 1099 DIV. All of these were supposed to be out by January 31st, with the exception of your broker statements with your dividend income and capital gains and so forth. I think those have to be out by next week, I believe. February 15th, I think it was. What's that? This week. So basically, by the end of this month, or the very first part of March, you should have all the forms you need in the mail. If you had unemployment, you'll get another tax form on that. That's taxable. And for those that had retirement income, like from IRAs or pensions, you'll need your 1099-R form on that. If you have an investment and you had sales, sold mutual funds or stocks, there's the tax form on that you'll need to get. Again, those are coming probably within the next week or two. If you had Social Security, you should have a SSA form now already. If you were self-employed, if someone paid you for self-employment income, if it was $600 or more, they were supposed to send you a 1099 NEC. What's that? Non-employee compensation. And you'll use that you'll need that to complete your return. If you have income from certain investments, like real estate investment trusts, you'll need to get a K-1, and those usually come out in March sometime. If you're claiming itemized deductions, you should have had a 1098 now for your mortgage company. If you're claiming education credits, your college should have sent you a 1098-T, or you can get it online through your student account. So these are all forms that you'll need before you even begin your return. And like I say, you should already have a lot of these forms. There might be just a couple that are still coming in, like the 1099 from your broker or the K-1 forms. But you should have everything by the end of the month, I would think, by the end of February, very early March. Common errors, overlooked deductions I see on tax returns. Maybe this might be a good time to pause. Maggie, are there questions we need to talk about? Are you there? Okay, I'll keep going here. Some of the common errors I see is choosing the wrong filing status. That you think that would be simple. I'm either single or I'm married. Well, there's lots of other filing statuses. You can be head of household, which is basically a single parent that has a dependent at home, a child at home. You could file separately, married filing separately. My daughter and son-in-law do that because they have student loans, and it's actually to their advantage to file separately instead of jointly. There's also something called a qualifying widow or widower. So if your spouse died within the last 2 years and you have a dependent child at home, you could file as a qualifying widow or widower and get a lower tax bracket, lower tax rate. So be sure to choose the correct filing status. Improperly calculating the cost of when you sell securities. When you have a stock, let's say you bought a stock for $5,000 and they paid dividends throughout the years, and you use those dividends to buy more stock. Well, now when you go to sell that stock, your cost for calculating your gain or loss is not just the $5,000 you paid originally. It's all those dividends are also part of your cost that got reinvested. So often folks, don't, they claim too much in gain because they're not taking into account the cost of all those dividends they reinvested. Math errors, computation errors are a very common problem. Like I say, that taxable part of Social Security, the part of your Social Security you had to pay tax on, is kind of tricky. It's a tricky calculation. It's easy to make a mistake on. Another good reason to use software. A big problem is just failing to report all income, especially if you get a 1099, which is like retirement income and that kind of thing. Because the IRS gets those documents too, and they're going to match them up. So if you don't report income on your return that was reported to the IRS, you're going to get a nasty letter with a bill, and they'll charge you interest and penalties. So be sure to claim all your income. And there's a number of credits available. These credits are very worthwhile because they reduce your taxes dollar for dollar. So a lot of folks just aren't aware to claim these. Credits for education, not just for the first 4 years of college, but lifetime education credits. Credits if you pay for childcare. There's an earned income credit. If you're a low wage earner, there's a credit you can get, that supplements your wages. There's a credit for retirement savers. So if you contribute to a 401k or an IRA and your income is within certain limits, there's a credit. There's a credit for dependents. So if you have a dependent child under 17, you get a $2,000 credit per child, reduces your taxes dollar for dollar by $2,000 per child. And if you have other dependents, like a college age student, for instance, over 17, still at home, going to college, you get a $500 credit for them. So these are all really valuable, and a lot of people just overlook them.
Tom, this is Olivia. We did have a question come in. Do you advise requesting a secure filing PIN from the IRS in order to protect tax information and identity?
Yeah, that's a good question. The IRS just changed the rule on this. It used to be that the only way you could get a PIN, and maybe I should back up and describe what that is. What that is, a lot of people had a problem with their identity was stolen, and people were filing tax returns using their name and social number. And then those refunds would get paid to the scammer, and then you'd come along with your tax return, your legitimate tax return, and the IRS would say, why are you filing? You already did. And it was a big mess. So what they did to try to combat that is the IRS allowed you to apply to them for a PIN, personal identification number, I think it stands for. And what they do is they go through all kinds of gyrations to make sure that it is you that is applying. You have to properly identify yourself. And then every year they will mail you a 6-digit number that you have to put on your tax return in addition to your social security number. And the IRS won't process your return once they send you that PIN unless you show that PIN on your return along with your social number. So it's a way for them to, again, verify that it really is you that's sending the return. It used to be they only would issue those PINs for people that had already been victimized by identity theft, who already had this problem with somebody filing a return in their name. But now they will issue it to anybody. So anybody can apply for a PIN. I think it is a good idea. It's certainly another way to protect your identity, at least on your tax return, and make sure that somebody doesn't file a return under your name and social number. And like I say, you have to apply just one time, but then every year they'll send you a new unique PIN, so you don't keep using the same one over and over again. You can apply online. I think if you Google it, just Google apply for IRS. They call it the IPIN, IPIN, or just say identity protection PIN number. And you can apply online, and they'll go through all kinds of questions and things to verify that it really is you that's applying before they will issue you the PIN.
Tom, we have another question. If you sell stock in a mutual fund, do they include reinvested dividends in your cost basis? And can you get this information from them, or do you have to keep track of it yourself?
Okay. Beginning, they do have to report your cost basis to you. I think it's beginning for any stocks bought after, I believe, 2012, maybe 2013. So they will report your cost basis to you, and they will include all those reinvested dividends. So you don't do that. You have to do the homework. It's there right for you. But if you had an investment that you bought prior to that, like I say, I think it's 2012 is the year. They don't keep track of that cost basis. So it's up to you to keep track of it. And I can't tell you how many people come to me and say, I sold this stock that my grandmother gave me in 1964. And, I have no idea what my cost basis is, but I sold it. How do I calculate my gain or loss? And if you have been with the same broker all those years, If you haven't switched brokers, they can usually help you calculate that because they'll have the records. But if you moved your investments around, obviously they're not going to have all of the prior year records. So what I'll do sometimes for people that come to me with really old stock that they've sold is, you can go back and Google what a stock price was over the years. And we use that to kind of try to reconstruct what that cost basis was. But luckily for anything that was bought after 2012, I think, right around there, the work is done for you and they will report the cost basis to you, including all those reinvested dividends. Any other questions out there?
No, not right now. Thank you.
Okay. Another big problem I see, or a common error, is on the direct deposit, the wrong bank information. You don't want your refund going into somebody else's bank account. So be sure you have your correct bank routing number and account number when you file your return. Failing to deduct gambling losses to the extent of winning. So, if you're lucky at the casino, they're going to send you a tax form on that. And that gets reported to the IRS, those winnings. But you can deduct, if you itemize deductions, you can deduct your losses up to the amount of your wins. You can basically zero out that taxable winning by deducting your losses. Failing to deduct long-term care insurance. So like I mentioned earlier, that's a deductible medical expense. Failing to deduct if you pay mortgage insurance in addition to your interest, that's a deductible expense. If you refinanced your loan, very popular in the last few years with low rates. If you refinanced your loan and you paid points to refinance, those are deductible as an interest expense, but they do have to be deducted over the life of the new loan. So if you took out a new 30-year loan, you can deduct 1/30 of those points every year. But if you go and refinance again 5 years down the road, any points you haven't deducted yet can be deducted all in the year you refinanced again. Failing to deduct medical transportation and lodging costs. So not only your doctor bills and medical insurance, but you can deduct mileage to doctor's appointments and so forth. If you have to go out of town for some sort of a medical appointment, lodging costs are deductible as a medical expense. Out-of-pocket charitable activities. So again, not just the money you gave, but if you donated to a food bank or anything like that, and your mileage also related to charitable activities are all deductible. So these are just some of the common deductions I see that people miss when they do itemized deductions. Another error is failing to make estimated payments. So, the IRS, they want their money during the year. You can't just wait until April 15th and pay your entire tax bill all at once. You have to pay throughout the year through withholding if you're working, withholding from your pension payments, and or you can make estimated payments. You can actually send in quarterly estimated payments. And the rule is that you have to have paid in at least 90% of your final tax bill or 100% of the final taxes due for the prior year in order to avoid any penalties. So if you haven't paid in at least that 90%, you're going to get hit with an underpayment penalty for failing to pay during the year. It's important that you calculate and make sure you're having enough taxes withheld or making those estimated payments. A lot of people want to know if their return is going to be audited. Audits are very rare. Less than 1% of all returns are audited. And typically the audits, they don't call you in and go through every number on your tax return. Typically you'll get a letter questioning one item or a couple items on your return. And they'll want you to send in documentation. They have 3 years from when your return was due to audit, unless they can prove that you were out and out fraudulent. So, for example, that 16 return that was due April 15th of 2017. So they had until April 15th of 20, 3 years from when that return was due, to audit that 2016 return. After that, the audit period is closed unless, like I say, they can prove that you were fraudulent, basically lied on your return. So I advise keeping your tax return copies for at least 3 years. Typically, I usually keep them about 5 years. I can't tell you how many people I work with that tell me they have every tax return back from 1962, in a file somewhere, but no need to do that. Just keep the most recent 5 years, I would say, to be safe. Obviously, shred those old ones. They've got all your personal information on it. Some red flags where you might get a challenge is if your deductions are out of line with your income. So if you have, $40,000 of income and you claim a $20,000 charitable deduction, that's going to raise a red flag. So they know what the averages are for deductions based on your income. And if you're way out of line with those averages, you might get flagged. If you charge or claim a large amount of non-cash charitable deductions, so $3,000 worth of stuff that you gave to Salvation Army or whatever, that's a red flag. If you have a business, if you're self-employed, or if you have rental real estate and you're consistently deducting losses, they never make any money, that's certainly an audit red flag. Failing to claim all income, like I mentioned earlier, that's an audit red flag. The IRS, gets copies of those income documents, and they're going to match those up. And for self-employed people that claim the home office deduction, that is often a red flag. And the rule on that is that to claim the home office deduction is supposed to be an area of your home that you use only for the business. So I don't know how they would actually prove that. If I had an office, how would they know if I ever went in there to do something personal? But that is the rule, that to claim the home office deduction, it has to be an area in your home used exclusively for business. And that is another audit red flag. Okay, how are we doing on time? What time is it, Maggie?
It is about 6 minutes after 7.
Okay, so we've already gone a little over an hour. Do we have any questions out there we have to talk about in chat?
Not right now. No questions.
Okay.
Oh,
Well, obviously, you can log off whenever you want to. I do have a few more slides on some tax reduction strategies that you could consider. So I will keep going here for, I probably have about another 10 or 15 minutes, and then we'll wrap it up. So one tax strategy that's very advantageous is it's actually a pay more tax strategy. And that is where you would convert money you have in a regular traditional taxable IRA to a Roth IRA. And you might want to consider doing that because right now our tax rates, like I say, we had a tax cuts, and our tax rates are at an all-time low. They haven't been this low in several years. So you might want to convert to a Roth now, pay your taxes now before the tax rates go up. And those rates, again, are scheduled to go up again in 2026. The other reason to consider it is that it's going to, you have to take a required distribution from your traditional IRA. But if you don't have to take a required distribution from your Roth. So if you get money out of your regular IRA and into a Roth, it's going to lower your required minimum distributions. The biggest advantage is that all the money, once you've got the money in a Roth, whatever you pull out of that Roth in the future is totally tax-free, including any earnings it's made. So not just the amount you converted, but all the earnings it's made come out totally tax-free, both to you and to your heirs. If you pass away with money in a Roth, tax-free to your heirs also. The only rule on that is that you have to have a Roth open for at least 5 years to pull out the money tax-free. I have a caveat there, beware of bracket creep. So, you don't want to convert too much to a Roth all in 1 year because it's going to push you up into a higher tax bracket. So I do a lot of strategizing with my clients to determine, what's the optimal amount to convert this year to minimize your tax bracket. And you can do conversions every year. They aren't just a one-shot deal. It's important that you remember your required minimum distributions. Remember, everybody that was 70.5 going into 2020 has to take an RMD every year from their IRAs, not from their Roths. And the amount that you have to take comes right from IRS tables. The holders of your IRAs typically will calculate that for you, your RMD amount. And the penalty, there's a huge penalty if you don't take out the required amount, is 50% of what you should have taken out. So don't forget to take out those RMDs, very important, but not from the Roth. You don't have to pull them from the Roth. Another, I call a no-brainer strategy, is something called an IRA charitable distribution. So this is available to any senior 70 and a half and older. And what you can do is if you have to take an RMD, you can elect to transfer a part of that RMD or the entire amount up to 100,000 directly to a charity, and then you avoid paying tax on that amount. So if your RMD, let's say, is $10,000, that typically would be all taxable. But if you defer $2,000 of it, say, to a charity, and it has to go right from the IRA to the charity, the money can't come to you first, then you only pay tax on $8,000 of that RMD distribution instead of the full 10. And these can be done annually. They have to be done by December 31st. And it's a real no-brainer because most people can't itemize deductions now anymore. Like we talked about earlier, the standard deduction is so high. So it's a way to get a tax advantage for a charitable contribution, even if you don't itemize. So, if you have to take RMDs anyway, and you're giving to charity anyway, I don't know why you wouldn't do this. That's why I call it a no-brainer. It's absolutely, you should be doing this. I know a lot of people at our church, what they'll do is they'll do this right at the end of the year for their entire annual giving for the following year. So they'll send money right from their IRA to the church for their full amount of their following year contribution that they were going to make anyway. And then that avoids them having to pay tax on that part of the distribution. There's a lower tax rate on long-term capital gains. Long-term capital gains are anything that you've held, any investment you've held at least 1 year or more. They get special lower tax treatment. So if you sold a stock or a mutual fund, if you have a rental property you've had over a year that you sell, or other investments, they are taxed at lower rates, as low as zero tax if you still fall within that 12% tax bracket, which is taxable income there, the amounts I have there, a little over 40,000 if you're single, a little over 80,000 if you're married. So if your taxable income, including those capital gains, falls below those amounts, zero tax on those long-term capital gains. And that's based on taxable income, not your gross income. So again, it's after your standard deduction. Even if you're higher than those thresholds I gave you to give you the 0% rate, they're still taxed at a maximum of 15%. So that's still a real deal when you consider that, the bracket after 12 goes up to 22 and then beyond that. So as high as 35 or more. So you're still going to get a capped capital gains rate of 15%. But again, be sure you've held that investment at least 1 year. I see so many people that sell investments that they've held less than a year, and they end up paying full tax on that gain when they could have paid, a much lower or possibly zero tax. So it has to be a long-term, held at least 1 year. And if you're in a net loss position on all your stock or mutual fund transactions, you can deduct those losses up to $3,000 in net losses. And if you have more than $3,000 in losses, you can carry them over into future years. So if you were unlucky and lost, $30,000 in 1 year in the stock market, you can deduct $3,000 per year against your other income every year until that $30,000 is used up. Also, you still have time to contribute to an IRA. You can make an IRA contribution up to April 15th of this year and claim it on your 2020 tax return. The maximum contribution to an IRA, and again, you have to have earned income for this, but the maximum contribution is $6,000 or another $1,000 for if you're 50 or over. And you can deduct that on your tax return. So, that's still something you can do now to reduce your 2020 return or taxable income. You cannot contribute to a Roth at all if your total income are over those limits I have there on the screen. So you can always contribute to a traditional IRA. There are no income limits, but you can't contribute to a Roth with those higher income limits. And you may not be able to deduct all of that traditional IRA contribution if you have some sort of a retirement plan or a 401k plan at work. There are income limits on that, on your deduction if you have a plan at work. The other things to be aware of, if you sell your primary residence, I know a lot of seniors that are downsizing, selling their home they've been in for 30 years. Any gain on that home sale is tax-free, up to $250,000 in gain if you're single or $500,000 if you're married. You just have to have lived in the home. I think it's either 2 or 3. I think it's 3 out of the most recent 5 years as your primary residence. And then if you meet that requirement, you can exclude that gain up to those amounts on that sale. There are estate taxes on top of income taxes, but the limits on that are very high. So estates are only taxed if they have estate total asset value of over almost $11.5 million if you're single, or $22.5 million if you're married. So, not too many folks pay estate taxes anymore, but they are out there. You can make annual gifts to anyone for up to $15,000 if you're single, or $30,000 if you're married. And you don't have to pay tax on that, and the receiver, whoever you give the money to, does not have to pay tax. All it does is that it reduces that amount of that estate tax that you can pass on without paying any taxes. So, for instance, if you gave $100,000 to somebody, $85,000, that excess over the $15,000 will come off the $11.4 million, and you can pass on tax-free before you pay estate taxes. Not a big deal for most people. Remember that you can contribute to a Michigan College 529 plan. It has to be a Michigan plan, and you can deduct up to $5,000 in contributions if you're single, or $10,000 if you're married, on your Michigan return. They're not deductible on your federal return, but they are deductible on your Michigan return. The other thing to consider is that if you pass on, your heirs that inherit your home and your other investment assets will get what's called a step-up in basis. What that means is if you bought your home for $50,000 in 1962 and it's now worth $300,000, the cost for your heirs to consider when they sell that home to determine if they have a taxable gain, their cost is considered whatever it was worth the day you passed away. So in that example, their cost would not be the $50,000 that you paid for it. It's the $300,000 that it was worth when you passed away. But you have to be careful. A lot of people like to put their kids on their home deeds before they pass away. They think that would be easier, make it easier for them, after they pass away. But be careful about doing that, because that would be considered a gift, and you would lose that step up in basis. If you add your kids to the title before you pass away, now their cost is going to be your original cost. They won't get that step up in basis. So be very careful about that. There's no tax on life insurance, or again on money in an IRA for your heirs. And remember the rule we talked about earlier, that if your heirs do inherit your IRA, your traditional IRA or a Roth, they do have to zero that out, clean it out within 10 years of when you pass away. And with that, that's everything I have. So do we have any more questions out there, Maggie?
Yes, we have a couple. One is, if your wife doesn't work but helps with your business without receiving a salary, would it be worthwhile to pay her a salary so she can contribute to a Roth IRA?
Yeah, you could do that. Of course, that's going to be income for her too, though. So I'm assuming this person is self-employed. They have their own business. So yeah, you could put your wife on the payroll. It has to be legitimate. She has to actually be doing work for the business. And you could put her on payroll, and then she would have earned income and would be able to contribute to an IRA. But she's going to have to claim that income too. So, you get a deduction for the salary expense, but she's also going to have to claim that income. So it's kind of a wash there. But it would allow her to contribute to an IRA.
Okay, another question is, this is about gifting. Does that mean you can gift up to 50K to multiple individuals each year, not 50K in total?
Well, first of all, the limit, if you're married, is $30,000 that you can contribute. And it's $30,000 per donee. So yes, you could give $30,000 away to several people, and you would not have to file a gift tax return and reduce that estate tax value, those big numbers that I told you about earlier.
So basically, if you had 6 children, you could give them each $15,000 apiece.
Or 30,000 if you're married. 30,000 apiece if you're married. Yep.
Let's see.
And you can give them more than that. But if you give them more than that, you are going to have to file a gift tax return. There's no tax on it to them or you, but you have to file a return because it's going to reduce that $22 million estate value, that you can pass on tax-free. Now, instead of 22 million that you can pass on tax-free, it'll be reduced by whatever amount you gave over the $30,000 limit. Hope that makes sense. It's not going to make any difference to most people because they don't have estates of $22 million.
Right. Another question is about Roth IRA. If you're just working a part-time job, can you do a Roth IRA? Do you have to make so much money to do a Roth IRA, or how does that work?
You can contribute to a Roth IRA, but not more than your income. So the limit is $6,000. But if your income is lower than that, then you can only contribute the amount of your income, up to your income. So if you only made $3,000, you can only contribute $3,000. If you made more than $6,000, the limit is $6,000.
Mm-hmm.
Okay, so yes, you can contribute even if you work just a little bit, but you can contribute more than your income if it's less than $6,000. Okay.
Any other questions? Any other questions? Well, thank you, Tom.
Welcome.